Welcome back to the show, the Austin Zaback Show. I'm your host, Austin Zaback. Today we've got, by popular demand, Zack Haptonstall back in the house, round 2. Today's going to be a little bit different than round 1, though. So if you did watch round 1, definitely stay till the end of the video for round 2. It'll be a much shorter episode, but we're going to do a bit of a deep dive into a particular deal that me and Zack actually partnered up on. I'm the co-GP with Zack. Zack's obviously CEO of Rise48. If you haven't watched the first one yet, we'll dive into a little bit of his story. But I appreciate you coming back on for round 2, Zack.
Yeah. Thanks, Oz. Happy to be here, man. Looking forward to it.
For anybody who didn't watch, our very first episode, right? Which, by the way, if you're watching, round 2 and you haven't watched the first one, we'll link that down below. So definitely go check that out. But maybe just a quick backstory, Zack. I know that, you've, and by the way, for those of you watching, Zack is a legend in the industry in under a decade, right? We're talking about $2 billion under management, almost $1 billion in equity raised, right? I think 53 total units purchased, 11 units actually full cycle.
That's right, yeah.
No capital calls, et cetera, right? So maybe dive in a little bit, like, how did this all come to be?
Yeah, no, thanks, Austin. Yeah, appreciate you having me on, man, and really fortunate. And so, yeah, honestly, I had no background in real estate. I kind of just grew up in like a lower middle class family here in Phoenix, Arizona. And I just wanted to create passive income, right? So I had done well like in healthcare marketing, making a good W-2 job. I quit the job, lived off of savings. We figured out how to buy the first little 36-unit apartment building here in Phoenix, and then really just started raising money from investors. And all the profits that we made, we'd reinvest in the company and build infrastructure. We started a property management company, a construction management company, started buying all our materials directly wholesale from overseas. So now we have over 250 full-time employees. We started locally here in Phoenix as we're recording this podcast. Then we opened up an office in Dallas, Texas, which we'll talk about, I'm sure.
Yep.
And then we just opened up an office in Charlotte, North Carolina. And so, yeah, for us, it's just a conservative strategy that we believe in, that we feel like we can rinse and repeat, where we're just buying these large multifamily apartment buildings. They're highly occupied day one. They're cash flowing day one. And for investors, it just offers completely hands-off passive investing, where they just get a check in the mail or direct deposit hit their bank account first week of each month. And so we've been fortunate. We've had thousands of investors now, like you said, raised almost $1 billion of actual cash from investors, and they've all been really happy. So it's been a fun ride.
Yeah, really, really cool. And really awesome just to see what you've accomplished. I know that there's a lot of guys out there that attempt to do what you guys are doing, right? And I think that everybody's got kind of their own rhyme and reason, but you guys have really, I think, separated yourself in the market, right? Like when I really look at it, obviously I've interviewed a couple of hundred people on my podcast. I'm super familiar with other big kind of syndicators in the market and stuff like that. But you guys are different, and you're different in a lot of ways, I feel like. You're different in the fact that you vertically integrated property management, construction management. You're different in the fact of the type of the assets that you actually buy. You're different in the fact that the places you buy them, right? You buy in red states, landlord-friendly type stuff, right?
Right.
And there's multiple. We could keep going on and on about like what kind of separates you. So maybe you could elaborate just a little bit on that. And I know you're a super humble guy, but like what separates you from maybe, and obviously we're not ever going to name names, but maybe other people out there trying to do the same thing?
Yeah, and it's a good question, Austin. And there's a bunch of syndication groups out there, right? There's hundreds or even thousands of them in the country now. And when we got into this, we had a vision to build like a true private equity firm. Like, to be honest with you, I don't even like to be called a syndicator, because we feel like there's like a negative connotation with that now, where like there's a lot of people that have raised money from investors. They'll buy a deal, they'll slap a third-party management company on there, and they're in a completely different state. They have no staff there, and they just don't really have full control, right? So I think the biggest thing that's made us different is we've wanted to build a truly built-out private equity firm with infrastructure, meaning that we are vertically integrated. We have our own property management company where we can control all the on-site operations. We have a construction management company, so we can control all the renovations. And then we buy all of our materials directly wholesale from an overseas manufacturer at fixed pricing, and just gives us that advantage. So we can actually do a higher level interior renovation scope, but at a cheaper cost. And it just allows us to systemize everything, Austin, where we can kind of rinse and repeat that same plan. So I think, and the other thing is just kind of staying laser focused, right? I think it's easy. In real estate, you can make money 1,000 different ways in real estate, right? And it's tempting sometimes. We see the shiny object syndrome, but we try to stay laser focused, where I tell people we're kind of like a very vanilla, boring company, where All we do is buy existing value add multifamily deals that are cash flowing day one. We go in there and we renovate them to the exact same scope that we always do, and we just rinse and repeat. We don't develop new apartments. We don't do self-storage or mobile home parks. And so just kind of having that blueprint, so to speak, in place has helped us to grow and scale and kind of set ourselves apart.
Yeah, so cool. Maybe elaborate too a little bit on, I know that you're very specific on the type of asset that you buy.
Yep.
You see there's people out there, right, that they focus on, let's just say Class A, like maybe Optima type of, if anybody lives in Arizona, maybe you're familiar with the Optima, the buildings that have all the green stuff growing on them, right? All the plants and everything like that. So you have like the Class A luxury apartment living, right? And I know guys that buy stuff like that. And then you've got guys that buy the opposite end of the spectrum too. We're talking Class C, Class D, maybe even like all the way to, government housing, all types of stuff, right?
Right.
You buy a very specific type of asset. What type of asset is that you buy, and can you elaborate on that?
Yeah, great question, Austin. So we're focused on what we call B-class assets in A and B locations. So primarily 1980s vintage assets. So these are clean, safe communities where the majority of the population lives. We're looking at median income, right? We're making sure that the people that are in that 1, 3, 5 mile radius can actually afford those rents. We'll shop all those comparable properties nearby. And so we'll say, okay, if I'm going to buy X property, are A, B, and C properties nearby, what are they getting right now for a renovated unit rent? And if I renovate and spend X amount of dollars into this property, can I conservatively push my rents up to what they're already getting to get that value add for the investor, but also keep it affordable for the resident and the tenant, right? So we are constantly cranking through underwriting and evaluating these deals, and it's like a needle in a haystack, right? We're underwriting hundreds and hundreds of deals to find 2 or 3, okay? And we're also focused, specifically like we talked about, Phoenix, Dallas, and North Carolina, because those markets are top 5 for job growth, population growth, they have diversified employment, and they're landlord friendly, which means that if somebody doesn't pay their rent, we can evict them in 30 to 40 days and make sure that the property is continuing to produce income, for the investor. So that's specifically what we look at. Like you said, we're not buying Class A luxury apartments, because when you look at it historically, like during 2008, 2009, right? Everybody loses their single family homes. They can't afford luxury Class A apartments with $3,000 rents. And those people trickle down into this B-class housing because it's affordable, it stays highly occupied, it cash flows during downturns. And so we feel like we can really be insulated and conservative with this type of investment during downturns. And then when you do have the good times, like 2019 to 2021 here in Phoenix, and rents are just taking off, you get the explosive growth, you get really strong returns for investors. So we feel like that's kind of, our sweet spot and our focus.
Yeah, no, I love that everything you say is so true, right? When it comes to that, and the other thing too, right, is that the people in like the 08, 09, and I guess like if we were to ever experience something like that again, which I'm sure at some point we will, right?
Yeah.
To some degree, history repeats itself. I'm sure it'll look different eventually, but the people that are living in the Class A luxury, they also step down.
Yep.
Right. They step down into, a different, whatever that step down is. I mean, they're going from like right now, the Optima, it's insane. I mean, I live at the Optima, right? And a 2-bedroom apartment is like, if I told you the rent, it's like, dude, like I can't even believe it half the time. Right. Yeah. And you look at all the people that are there, right? If something bad happened in the economy, half those people, I know for a fact, I see them on the elevator every day, they would be moving into a different apartment complex. Yep. It's just the truth of the matter.
Yeah.
And it's just the way the world works, right? And so people, unfortunately, have a tendency to live above their means. They don't save money. I mean, Americans are notorious for that, right? Yep. And so it's your duty and obligation as, the CEO of Rise48 to future-proof what you're building, right?
That's exactly right. Yep. Yeah. So you're exactly, you get that trickle-down effect. And when we looked at it historically, we're like, okay, these types of assets performed well during downturns. They performed well when the economy was strong. And I tell people, Austin, that this is not like a tech company or like an app. I'm not going to 10x your money in a year or two, but it's also very conservative, right? Because these deals are cash flowing and, they're staying highly occupied. So that's a big differentiator.
Yeah, no, huge differentiator. And I want to talk a little bit about the Arlington deal, and we can kind of maybe dive in a little bit into that. Yeah. And I also want to talk just real quick, I guess maybe before we jump into that, one thing that maybe I'll bring up is the fact that over the last, probably 18 months, you've looked at okay, we went from a 2.99 average percent interest rate. I mean, the 10-year treasury was zero practically at one point,
Right.
right? And then all of a sudden, so you had all these people that were syndicating, right? Or doing whatever, buying deals. I mean, even single family guys that got into bad debt. And then over the last couple of years, it made it pretty difficult. I mean, you've seen a lot of the headlines. You've seen a lot of the people out there. A lot of people have done capital calls, stuff like that.
Right.
You know, I said in the beginning, you guys have never done a capital call. To me, that like when I saw that, I was like, wow, okay, like there's got to be a reason for that, right?
Yeah.
In your opinion, what is that reason that has insulated you aside from? I mean, a lot of it probably has to do with everything we just talked about too, right?
Yeah.
But is there anything in addition to that that has insulated you from having to do anything like that?
Yeah, I mean, the biggest differentiators, Austin, are that we've always taken lower leverage loans. Okay, so like our average loan to value upon the deals that we own right now upon acquisition, 67% loan to value. What does that mean? It means we had at least a 33% cash down payment. Okay, a lot of the groups that are in trouble had an 85% leverage loan. So they had a much smaller down payment. You have more debt. When interest rates skyrocket, you have more debt to pay, right? A lot of them bought short-term interest rate caps, maybe 1 year. Some of these guys didn't have any caps. We've always bought longer-term caps. And a lot of people had little to no reserves that they raised as like liquidity in addition to the down payment. And we've always raised a lot more reserves. And then the fourth thing is really what we've talked about is being able to execute a value-add plan. So the reality is that for like the 5 years prior to 2022, before interest rates increased, anybody could buy these deals, call them value add, do nothing, and then rents take off, cap rates compress, values go up, and you sell them, and you look like a genius. And it benefited us too, no doubt. It juiced our returns, right? But the difference maker is that we've been able to build out infrastructure to truly renovate these units. So as an example, last year, 2023, in Phoenix, there was negative 4% organic rent growth. You're talking about a market that 2019, 2021 was like 10 to 20% a year rent growth, negative 4% last year. So if you weren't renovating, your rents were going backwards. We renovated 1,923 units in 2023. Our average rental increase was $453 per unit, which was $20 above the initial projections. And to be honest, in the initial projections, we weren't assuming negative 4% organic rent growth in 2023. So we still were able to overcome it. And so it just goes to show you, if you have the infrastructure to execute the plan, you're not as vulnerable to just organic rent growth, right?
Sure.
You can kind of fight back against that. And so that's been some of the big reasons. And I was telling somebody recently, not only did that allow us to kind of weather the storm and get through unscathed, no capital calls, never lost investor capital, but like you said, Austin, there's a lot of distress in the entire commercial real estate industry the last 24 months. I mean, you have massive institutions that we all know the names of that have gotten foreclosed on just recently, right? So this is happening everywhere across the country. And what that presents is a very unique opportunity to buy new deals, right? And so, we were the top buyer in Dallas in 2023. Because we were coming in there and investors were seeing what we're doing. They were happy, and we're getting all these off-market deals at a really good basis from sellers that were facing pressure from their loans. So, we still think that this window is open the next 6 to 12 months to buy these deals at a really good basis. And the crazy thing is the net operating income, like the amount of money these properties are producing each year on the deals that we're buying, most of them, they're producing a lot more money now than they were 2 years ago. But we're buying them for 20 to 30% less than they were selling for 2 years ago, all because of interest rates. And when those rates come back down, values will go right back up, pretty quickly. And so that's why we have, some unique opportunities. I know that we're partnering with you on this deal in Arlington that we're really excited about, and that's one of those opportunities.
Yeah, and I'd love to talk about that deal. You know, so I had you on the podcast quite some time ago, man. Gosh, I mean, it must have been over a year ago, probably. Yeah. And I've known you even before that. I mean, through Jason Mitchell and through various other people. I've obviously. Tons of people have spoke very highly of you. I've seen you at a lot of events. You guys have actually sponsored multiple events. I think it was the one of the events about a year ago. What was it? The Aaron Pearson threw that event. I forget the name of it. But anyways, you sponsored that event. Phenomenal event, right?
Yep.
A bunch of big speakers, and so you've been very prevalent, obviously, in the industry. So we met, we had the podcast, and I told you, right? I said, look, you're kind of doing eventually what I eventually wanted to do. This is kind of a dream of mine to eventually get into the multifamily. I've obviously dominated the residential world. I've sold, at least 5,000 homes in my career, billions of dollars in real estate. We do a lot of volume, and I'm like, okay, like I want to play in the big leagues, right?
Yeah.
But then to your point, I chatted with you and I said, but Zach, the reality of it is like you have the infrastructure on the back end. I might have the reach. I might have the following. I'm really good at the front end. I'm good at the belly to belly, bringing people in, attracting people, stuff like that to a good opportunity. But you've got the vertically integrated everything on the back end, right? And so I guess, with all that being said, the Arlington deal, right? We ended up, I said, okay, let's just partner.
Yeah.
Right. As opposed to me trying to do it on my own.
Right?
Make it easy.
You do what you
do
best. We do what we do best.
Yep.
And I know you did a lot of due diligence on that deal.
I did.
Beforehand, which was good. And you've been doing due diligence on us for a while now. So.
And I loved that deal initially when you told it about me, because it was a direct-to-seller deal, right? It was an off-market deal that you guys bought, which these are all things that I love in the single-family world too, right? Yep. Like anybody watching that knows anything about real estate, when you hear off-market, direct-to-seller, you're like, your ears kind of perk up. You're like, all right, like, what are we talking about?
Those things
right?
are similar, whether it's single-family or large multifamily,
exactly,
right?
And then the other piece of the puzzle was, that maybe you can elaborate, but you said, Austin, we already bought the deal, right? You said we already bought the deal. We're already our construction manager. We're already renovating the deal, right? The deal's already cash flowing.
Yep.
We're just backfilling the reserves on this deal, right? And and that was kind of that third thing for me. And then of course it was in a great market. I saw the value add play, black and white, clear as day, right?
Yep.
I think it's 61% of the units, adding the washer and dryer, and then, renovating the remainder of the units and getting it up to shape, right? So maybe in your own words, tell me what attracted you to the Arlington deal.
Yeah, absolutely. Yeah. So Rise West Arlington, I'm really excited to partner with you on that, Austin. So we sourced it completely off market, like you said, directly from a seller who we have a relationship with. And unfortunately, due to the interest rate environment, they needed to sell this deal, right? And so we're getting it at a massive 20 to 30% discount from where it would have sold just 18, 24 months ago. And there's a ton of value at upside left, right? So we can renovate over 70% of these interior units. And this deal, it's over 200 units. So it's a large, established multifamily deal. Like you said, cash flowing day one. We can renovate the majority of the units to our higher level scope. And for people to understand what that means, we're buying these deals. They've got the original flooring from when they were built in the 1980s. They've got white appliances, old cabinets, old countertops. We go in there and basically gut the unit and do quartz countertops, stainless steel appliances, brand new cabinets, brand new flooring. So we're giving these residents a Class A luxury interior scope, but it's in this B-class workforce housing type of product, which is still affordable. That allows us to increase the rents, which increases the value of the asset, gets us that profit margin for the investor. So not only are we buying this deal with no competition at a very low basis, a very low price per door, massive discount, but we can go in there and push the value even more by renovating the units and adding washer dryers, like you said, Austin. It's the single easiest thing we can do. Okay, so we'll budget to increase rents by $50 per unit that we add washer dryers to, and you'll get that all day. We have deals in this Dallas market that we're getting $125 just by adding washers and dryers. It's the single biggest thing that people want. They don't want to have to lug their laundry to a laundry room, right? They want it in the unit. So all we have to do is pop those in. So it's an easy thing to do. But yeah, I mean, we've already closed on the deal. We're just backfilling some reserves. We have limited spots, as you were mentioning. And so there's no execution risk of the actual acquisition. The deal's cash flowing. It's doing really well. We're going to be finishing up the exterior paint here pretty soon. So we have, right now we have 11 deals, almost 3,000 units in Dallas-Fort Worth. And we've got 2 deals that are within a 10 to 15 minute radius of this deal, both in Arlington. We bought last year. Those assets are both performing really well. Okay, so the deal is close to Dallas Cowboys Stadium, University of Texas at Arlington, these major employers right in the heart of the Dallas market.
Yeah, such a phenomenal deal, and we'll link everything down below for anybody who might be watching the long form video. We appreciate you. We are looking for accredited investors to come in on the deal before we close it out. We've got a couple people probably left. I mean, at a certain point, if we're gonna have to turn people down, they'd have to come in on the next deal, right?
Right.
It's not unlimited.
Yeah.
But it truly is just just a great deal, right? And I really do believe in your guys' capability of turning that deal. Like you said, I mean, you own over 3,000 doors in that market. You have an office in that market, right? You know what you're doing, so there's no ifs, ands, or buts. Maybe we can talk a little bit about, people coming in on the deal. What does that look like? How do you guys structure, when people come in? And I know obviously everything's regulated by the SEC, right? Of course, so we want to make sure that we're, operating in the black and white. So how does it work? How can people come in? Obviously, they have to be accredited. Are there different tiers, et cetera, that people can come in?
Yeah, great question, Austin. So we're regulated by the SEC. You have to be what's called an accredited investor, and so you can kind of look up the definition of what that means. And I'll give a disclaimer: I'm not an SEC attorney, right? So, but basically, you have to be an accredited investor, which means that typically the definition is if you're an individual, you've made $200,000 or more the last 2 years, and you expect to make that this upcoming year. If you're married, it's $300,000 or more, or you have a net worth of $1 million or more, not including your primary residence. That's one of the SEC definitions. There are some other ways to qualify, so you can kind of look into that. But basically, it's a $50,000 minimum investment. Okay, so for $50,000, you're going to get what's called a 7% preferred cash-on-cash return. And more of the details are in the presentation, right, Austin, that you can provide to people. 70-30 split after that, 50-50 over a 2x multiple. And then there are, more preferential splits for larger investment amounts, which people can reach out to you for, Austin. But basically, you're going to get passive income hitting your bank account within 90 days of investing. So you're going to get monthly cash flow distributions, and we're going to be executing the plan. We always project a 2 to 5 year investment period. Okay, so we're typically projecting to double your money conservatively over 5 years. If we can sell the deal earlier and get a good return, we'll absolutely do that, right? So we're not in the business of long-term holding the assets. We're specifically going into this asset to execute a specific plan, renovate the units, add the washer dryers, improve the amenities, increase the value, and then we're going to sell it when the market conditions make sense. So if we can sell the deal in 2 or 3 years, we will, right? And then the investors get all their initial money back plus their profits upon the sale. Okay, so it's a good way to get passive income with monthly distributions. Think of it, I tell people, it's like owning a single family rental home on steroids, right? But you don't have to do anything. Right? So you just sign the paperwork, you wire the funds. We'll give you access to our investor portal. You have 24/7 access to this portal where you can access all the financials, everything that you and I have access to, Austin, the investor has access to. So bank statements, mortgage statements, general ledger, the balance sheet, they have everything. And then we send very detailed monthly investor reports that basically shows, here's the progress so far. We've renovated X amount of units. Here's the rental increases. Here's before and after photos. Here's the cash flow. All the KPIs and the metrics for budgeted versus actuals. They'll have all that transparent communication. And then, I'm not a CPA, so talk to your CPA. But there are potentially tax benefits as well, where you can get depreciation benefits. So a lot of our investors are investing to try to offset some of their active income and can take advantage of tax benefits by investing in commercial real estate. Yeah,
100%. And you mentioned too, Zach, and maybe we can elaborate a little bit, but we were talking to another investor a couple days ago, and we were telling them that, and obviously we can't guarantee it, right? But we were saying that I believe we're 7 out of 7, you're 7 out of 7 on the last, however many deals you've attempted to, you've been able to actually successfully 1031 into a new deal, right?
That's right.
And of course, the time with anybody who's familiar with a 1031, the timing, kind of everything has to line up. You've got to identify the new asset, et cetera. And the way that you structure the deals, right, is that each deal is owned by an individual LLC. You own shares of that LLC. So an investor, in theory, if we were able to successfully 1031 out of this thing, let's just say 2-3 years from now, right? Then an investor would have 2 choices, basically. They could get their initial capital back plus their returns, or they could choose to roll their initial capital and their profit into the new deal, right? And just continue on. And that, in theory, could be indefinite, assuming you successfully continue to 1031.
That's exactly right, Austin. Yeah. So you can defer the capital gains tax, by doing a 1031 exchange. And that is our goal. We tell people for every single deal that we are acquiring, our goal is a 1031 exchange when we sell it. And as you mentioned, Austin, the investor has the option to participate or they can cash out. They don't have to do it, but it's a good way to keep growing that money over the years, not having to pay capital gains tax. So as an example, and again, this is just an example, no guarantees obviously on investments, but for easy math, you invest $100K. If we sell that deal, and let's just say we double the money, we 2x the money, and you want to participate in the 1031 exchange, Well, you can roll the initial 100K that you invested plus the 100K of profits into the new deal, defer the capital gains tax, which means you're not having to pay capital gains tax upon that sale, and then your preferred return of 7 or 8%, depending on how much you invest, is now on 200K instead of 100K. Okay, so you've actually grown the money, you've paid no capital gains tax, you've increased your monthly cash flow significantly, and then based on your situation with tax benefits, you may be able to pay little to no taxes on the cash flow.
Yeah.
Right? And again, check with your CPA, your tax professional. But this is why people take advantage of the 1031 exchange, and they just keep rolling it over and over for years.
Who do you see, Zach, in your opinion, 1,000 investors over the years have invested in Rise48 roughly? Is that the number?
We've had about 4,000.
4,000.
Yeah, 4,000 individuals have invested so far.
So a lot of investors.
Yep.
When you look at the demographic, just out of curiosity, on average, you know, because we talked a minute ago, right, about, because I'm in real estate, right?
Yep.
And, you know, it's a lot of work. I mean, I've owned single family rentals. I mean, they're a lot of work.
Yeah.
They take a lot of time and energy. And I'm just curious, you know, what is the avatar of people that you see that like to invest in a deal where it's just park the cash and you do all the work?
Yeah, it's a good question, Austin. It's funny. So when we first started, the first few years, it was primarily high W-2 income earners, physicians, engineers, IT consultants, you know, people that are salespeople that are making, you know, 100 to 500K a year. And now we still have a ton of those people, obviously, but now we're getting a lot more high net worth people, a lot more business owners as well. And it's just funny because I can't tell you how many times I've heard a lot of our investors started buying their own single family homes. And they'll get 1, 2, 10, 20, and then they find themselves, and they have a job, right? They all have a job. And they're like, this is a nightmare having to manage this. And they're like, I don't want to do this anymore. And they learn about this passive investing, and so many people start selling off those homes and either 1031 exchanging those with us, or they're just taking the cash and investing it with us because they're getting the same or better returns with us by not having to do anything.
Yeah.
Right. And they can actually invest in different markets that they otherwise wouldn't have, because most people, and I would do the same thing. If I was going to buy single family homes, I'd want to buy them in my home market so I can go check on them. Right. But what if your home market isn't the greatest investment market? Right.
Yeah.
And so, you know, we've specifically built a company to operate these large apartment buildings, so that investors don't have to deal with all that, right? And so, yeah, we've got investors from all walks of life, but those are kind of the biggest avatars we see.
You know, we just had a call, you know, a couple days ago, maybe a week ago, with a gentleman, right, that I believe bought 30 or 35, I can't remember how many he said, but he owns like 30 or 35 single family homes.
Yeah.
And he's like, I don't want anything to do with it. I mean, he pretty much told us on the call, he said maybe he'll keep a few. But he said, look, I want out of these deals and I'd rather just come over here.
Yeah.
You know, and clearly, you know, he's just probably same thing, right? I think he's, you know, and I don't want to say too much, you know, obviously we'll protect his identity, but, you know, he's probably a high income earner, right? It just doesn't have the time. He doesn't have the bandwidth, you know, like even for me, I mean, I sold multiple rentals in 2023, single family rentals of mine. I think I sold one of my rentals even in early 2024 because I was just tired of it.
Yeah, it's another job, right? It's a pain in the butt.
Yeah.
And it's cool at first, but you're like, well, I like this $200 or $300 of cash flow. I want to buy another one to get more cash flow, but then it just becomes more and more work, right?
Sure.
So.
For anybody who may not be familiar as we wrap this up, you know, of the actual process, I know we kind of walked through it a little bit, right?
Yep.
Obviously, I'm going to, anybody who inquires, right, if you comment down below, like the video, however you inquire, I'll send you the deck, right? So make sure you send the deck. Me and Zach have filmed a video separate from this video breaking down the deal in further detail, right? And we'll send all that over to you. What is the actual steps of getting involved? You know, I know you mentioned, you know, verifying that they're accredited, et cetera, but how simple is it?
It's very simple, yeah. So like Austin said, you know, basically you can review the deck. There's a webinar recording. If you're interested, you fill out a soft commit link, which is like a 30-second form, basic info, name, phone number, email, how much you want to invest. And then we're going to give you access to our investor portal, and we have to verify that you're accredited, okay? So there's a few ways to do that. Basically, you could upload, you know, some W-2s to the portal. You could upload tax returns to the portal, and this is all, you know, secure, confidential. It's encrypted. There's actually a couple different templates that you could have your CPA or tax professional fill out. So we use a third party to help verify that you're accredited. And then after you do that, you will review and sign what are called the subscription documents electronically inside the portal. Okay. And so how this works, so people understand, Austin, is that we create one new LLC to buy each new apartment building. And when the investor's investing, they're buying shares of the LLC. So as an investor, you'll have actual ownership shares of this company that's been created to own this property. So when you're signing subscription documents, you're signing an operating agreement and buying shares of a company, right? And so that's why you're getting tax benefits, depreciation, you're getting cash flow distributions from the company, which is the apartment building, effectively. So basically, you soft commit, you just upload your forms to verify that you're accredited, you sign the docs. We then will give you wiring instructions. You call to confirm the instructions are accurate. We have our investor relations team at the office, and then you just send a wire transfer, and then we're done. And then we're done with the asset or done with the investment. You're gonna start getting monthly investor reporting, and you get monthly distributions from there. You can log into that portal anytime. You can always reach out to us with questions, and so it's a pretty seamless process. And after you've signed and wired, you're 100% passive, okay? And then each year during tax season, we will upload your K1 into your investor portal. Okay, those are the investors that aren't familiar. The K1 is kind of like the equivalent of a W-2, but for a business owner. So because you're investing in this new apartment building, you are a business owner of this apartment building. And so we're going to upload the K1. You just download that, give that to your tax professional. They can help you take advantage of the tax benefits.
Yeah, awesome. Incredibly easy, incredibly simple, And like I said, I mean, for anybody who's interested, we'd love to obviously be a part of the journey. I myself, Zach, I'm sure you too, we're more than happy to hop on the phone too if you reach out and you have any additional questions that maybe for some reason we didn't answer in either this video, the webinar that me and Zach did, or the deck. We're happy to take a call. And Zach has a huge team as well, so we can also take advantage of that. And Zach, I appreciate you for letting me partner up on this deal, and I'm excited about the future.
No, thanks so much, Austin. Looking forward to it, man. Thank you.